When the going gets tough, the market's had a pretty basic response for the last few years. It bets on the tough-going shopping. In every wobble recently, the right thing to do was to bet on the consumer, ignoring whatever the bad news was, from currency collapses, geopolitics, right through to government brushes with default. Instead, the consumer headed back to the mall. The same has been true so far this year, as you can see on this chart. Best performing stocks in the US, UK and Eurozone, once again in the defensive consumer staples sector. That's here where you've had really some quite positive performances, very positive performances in the UK, pretty good in the Eurozone and okay in the US, all of this in dollar terms. And in the more economically sensitive consumer discretionary sector, where the US has led, followed then by the Eurozone and the UK. And again, all of this is in dollar terms. Now, those have provided almost all the gains this year. In fact, the only other sectors that have provided anything positive in dollar terms are IT in the US and healthcare in the Eurozone. So the consumer has been absolutely essential. Even in emerging markets over the past 6 months, consumer stocks have been the best performers, although that really isn't saying very much. Both sectors fell, just not as much as the rest of the market. Now, it isn't just the stock market that's been relying on consumers. The world's been looking to the US to provide the lead for the economy, and US growth has come mainly from consumption, although investment hasn't been looking too shabby recently, it has to be said. Now, that reliance on consumption makes today's disappointing retail sales figures all the more worrying. Is the US consumer finally losing the will to shop? September sales, excluding cars and petrol, were flat. Previous months were revised down, while overall sales grew quite a bit more slowly than expected. Now, it's always risky to focus on a single month's figures, even when the revisions of previous months back up the negative view. But the data come as investors are battling with a fundamental question. Will falling oil and other commodity prices be good deflation or bad deflation? If consumers open their wallets and spend the money that they save at the petrol station on extra stuff elsewhere, then the economy as a whole ought to get a boost as imports get cheaper. But if they pocket the savings to pay down credit card and other debts instead, then falling prices are likely to spread and be fairly bad news for the economy. Now, disappointing retail savings definitely point towards a bad outcome, bring the strength of the US consumer into question. It's too early to be sure though, partly because the strong jobs market in the US and small business pay plans both suggest that workers are likely to be doing reasonably well. The uncertainty is worsened by the divergence between the two main measures of consumer confidence, the Michigan and Conference Board surveys. The Michigan survey, that's the red line here, has been falling back all year. It's hard to make out underneath, but it's come down a fair bit there. And it suggests growing concern, while the Conference Board survey, that's the blue line, has rebounded and stands basically at pre-financial crisis levels. You can see that there. Now, one difference between the two is that the Conference Board focuses more on employment, while Michigan focuses more on what you might call just money. So if jobs look secure, but pay rises aren't yet coming through, that might provide some explanation of the gap, although there are other differences between the two surveys as well. Either way, investors have made great money out of consumer stocks everywhere for the past 5 years. It's highly unusual for both defensive and economically sensitive consumer shares to lead the market for such a long time, let alone during panics. Cautious investors out there might like to bank their profits in case consumers choose to do the same.